In this video, we're ranking the most common assets people invest in, moving from the slow burners to the assets that show real sustainable momentum. Assets aren't just for investors in suits or people with millions in the bank. You already own some. Maybe without even realizing it, we'll look at everyday items you already own, digital tools you can build, and investments that can grow your wealth over time. By the end, you'll see that assets aren't just things rich people collect, they're tools you can start using today, no matter your starting point. And the best part? You might already have the first one sitting in your garage or in your pocket right now. All right, let's not waste another second. Welcome to Profit Pulse, and let's dive straight in. Kicking things off with the bottom tier, the assets that do the least for your wealth. Your bike, your car, your phone, these are personal use assets, they have value. But here's the catch, most of them depreciate over time. A car loses value the moment you drive it off the lot. Your phone, worth half as much a year later. But here's where it gets interesting. If you use them for a ride-sharing service or a food delivery app service, they can shift from being purely personal to income-producing. Take ride-sharing in New York City, for example. The per-mile rate is around $1.30, and a full-time driver can gross about $275 a day before expenses. That's not pocket change. That's a solid daily income from an asset you already own. Or look at bike delivery. A typical bike dasher in a busy city can expect to earn around $15 to $25 per hour. Over an 8-hour shift, that's $120 to $200+ in gross daily earnings. And unlike a car, a bike has lower maintenance costs and no fuel bill. Your phone is the control center for all of this, managing orders, tracking routes, processing payments, and even finding your next gig. I know people who started part-time food delivery just to cover their bills and ended up making enough to pay for the bike, the phone, and still have extra cash. And you don't have to stop there. That delivery bike and car could lead to a private hire business. That phone could be the hub for your next side hustle, from managing bookings to running social media ads. The key is to balance the wear and tear costs with the income they generate. Keep track of fuel, maintenance, and platform fees. If the numbers work, even depreciating assets can pay for themselves and then some. Think of it this way. The same car that costs you money every month could be the very thing that funds your next investment. The same phone you use for scrolling could be the tool that manages your online store. It's all about shifting your mindset from consumer to creator. Second stop, digital asset. They're not true investments, more of a hobby, but turning them into a commercial venture could elevate them to a higher tier. A digital asset can fall anywhere on the full spectrum tier, from the lowest ranks if it's neglected, unoptimized, or failing to deliver results, to the very top when it's well built and strategically managed, becoming a powerful wealth builder. Digital assets are anything valuable that exists online and can generate revenue. That could be a monetized YouTube channel, a popular Instagram page, a Facebook business profile, an Amazon seller account, or an Etsy store. Social media accounts can act as digital storefronts. Every post is a marketing asset that keeps working for you long after you hit publish. Pair that with an online store on Shopify, Amazon, or Etsy, and you've got a 24/7 sales machine. The beauty of digital assets is scalability. A single product video can reach thousands of people overnight. I've seen small sellers go from 50 orders a week to 500 just by refining their content and targeting the right audience on platforms like YouTube, Instagram, and Facebook. But here's the catch. You don't own the social media platform. Algorithms change, accounts get suspended. That's why it's smart to build assets you do own, like your own website or an email list. That way, you're not at the mercy of someone else's rules. Imagine this. You post a product demo on Instagram, it goes viral, and thousands of people visit your store. Even if Instagram's algorithm changes next month, you've already captured their emails and can keep selling directly. That's the power of combining rented platforms with owned assets. And remember, digital assets aren't limited to selling physical products. They can be online courses, downloadable templates, stock photos, or even apps you've developed. Anything that can be created once and sold repeatedly is a digital asset. The more you build, the more your income potential grows. The best part? Many digital assets have low startup costs. You can start with just your phone, free design tools, AI, and a bit of creativity. Over time, those small beginnings can snowball into a serious income stream. And here's a pro move, repurpose your content. A single product video can be expanded into a YouTube tutorial, clipped for Instagram Reels, turned into a Facebook ad, and even embedded into your Amazon or Etsy product listings. One effort, multiple income opportunities. Moving on to a D-tier asset, and with an edge gained from gold's consistent price climb, they can punch above their weight. Gold is one of the oldest and most trusted asset types, a store of value that holds purchasing power over decades. While it doesn't pay dividends, gold can protect your wealth during inflation or market crashes. You can own it physically, bars, coins, jewelry, or digitally through gold ETFs. Some entrepreneurs even use gold strategically in trade, for example, exchanging part of their gold holdings for high-demand goods during supply shortages, then converting those goods back into cash at a profit. In this way, gold becomes a flexible resource rather than something that just sits in a safe. Gold also has a psychological benefit, and it's tangible. You can hold it, store it, and know it's there. That's why many people keep a small percentage of their portfolio in gold as a safety net. And here's a tip. If you're buying physical gold, understand the difference between bullion and jewelry. Jewelry often carries a higher markup because of craftsmanship, while bullion is valued closer to the market price of gold. The key is to treat gold as a stabilizer in your portfolio, not your main growth engine. It's like the emergency brake in your car. You don't use it every day, but you're glad it's there when you need it. And when markets get shaky, that stability can be priceless. If you're new to gold, start small. Even a few grams can be a first step. Over time, you can build your holdings, and when the economy wobbles, you'll be glad you did. Now we're going to move on to B-tier asset. This is where consistent wealth building begins. Funds are pooled investments, mutual funds, index funds, ETFs, where your money joins thousands of others to buy a diversified basket of assets. They're beginner-friendly because you don't have to pick individual stocks. Instead, you buy into a professionally managed portfolio. That means someone else is doing the research, balancing the risk, and making sure your money is spread across different sectors. For income, some funds pay regular dividends. For growth, index funds track the market over time. The beauty is automation. Set up monthly contributions, and your investment grows quietly in the background while you focus on other ventures. I know people who started with $700 a month in an index fund. 7 years later, without doing anything fancy, they had built a solid 5-figure portfolio. That's the power of consistency and compounding. Your money earns returns, and those returns start earning returns of their own. And here's the best part. You can start small. You don't need thousands to begin. The earlier you start, the more time your money has to work for you. Even if you can only put in a small amount each month, the habit is more important than the size at first. If you're not sure where to begin, look for low-cost index funds that track major markets. They're simple, diversified, and historically reliable. And once you set it up, you can almost forget about it until you check your balance years later and realize how far you've come. And finally, we got this A-tier asset where the wealth game flips in your favor. Prime real estate snagged under market value in a booming area with minimal holding costs. Not all real estate makes the cut for A tier. Only the right picks, the ones that put cash in your pocket, grow in value, and hand you tax perks, earn that spot. One of those A tier plays is auction properties, where it can be a goldmine for savvy buyers, often secured below market value. They offer instant equity, potential for high rental yields, and quick resale opportunities that turn smart bids into real profits. Some investors even combine real estate with digital assets, using social media to market rentals or short-term stays. I've seen Airbnb hosts double their bookings just by posting short videos of their property on Instagram and TikTok. The downside, real estate is less liquid than other assets, meaning it takes time to sell. But for long-term wealth building, it's one of the most proven paths. Another real estate goldmine, this time with built-in liquidity, is by leasing an office space, flipping the layout, and turning it into multiple compact rental units that squeeze maximum returns from every square foot, creating a steady stream of income while boosting liquidity, giving you faster access to cash through consistent rent inflows, or the option to sell the upgraded asset at a premium. Whether it's a single apartment or a portfolio of commercial buildings, real estate has the power to generate steady cash flow and build equity over time. So, there you have it. Four very different asset types, but all with one thing in common: they can be put to work for you. Your bike, car, or phone might seem ordinary, but in the right hands, they're income tools. Digital assets can scale your reach far beyond your neighborhood. Gold can protect your wealth when the economy shakes. Funds can quietly grow your money in the background. And real estate, it can build a foundation for long-term stability. The truth is, you don't have to start with all four. Pick one, learn it, put it into action. Then, as your income grows, diversify into the others. That's how real wealth is built, step by step, asset by asset. Which of these will you start with today? Drop your answer in the comments. I read every single one. And if you found this video helpful, give it a like. Subscribe for more smart money tips, and hit that bell so you never miss a strategy that could change your financial future. Thanks for watching. And remember, it's not about how much you have right now, it's about how you use what you've got to create the life you want.